The Nifty, the Sensex, the BSE 500, they all constitute a fairly diversified set of companies, and a 12 to 15% return is pretty much par for the course. But then there's an equally diverse set of stocks that have been doing a bit better. Actually, they've been doing a lot better, and over the last 1 year, the SME IPO index has delivered a return of 126%, and over the last 5 years, this index has converted 1 into 20 rupees. In fact, just today morning, I saw this news clip, and this 400% honor goes to this company, Krishka Strapping Solutions, which at the time of its issue was oversubscribed 337 times. The recent performance of SME stocks has definitely boosted interest in this asset class, and what was just 27 IPOs in 2020, 109 in 2022, is expected to have almost 200 new listings in this financial year alone. The underlying premise is that small stocks have the potential to create big rewards for its investors, and it's a story that people like you and me have heard too often. And so in this video, I'll get into the crux of the matter as we explore this entire concept of SME investing. How is the SME exchange different from a regular exchange? The returns, risk, liquidity, some tips on how to select SME stocks, and of course, how to invest in them. Let's begin. According to government data, our country has 64 million ultra-small corporates, of which about 25,000 of them have revenues in the 50 to 200 crore range. These companies form the backbone of any large corporate and for the economy in general, with anywhere from 50 to 60% of the world's business being run by SMEs. Specific to India, 40% of our exports are through these micro, small and medium enterprises. About 30% of the country's GDP is from registered and unregistered SMEs. And if India continues on the same path that we see with developed countries, then there's definitely a lot of room for growth. So the obvious question is, why was growth lacking until now? And the biggest challenge SMEs continue to face even now is on account of limited access to capital and the untimely availability of credit. You see, these small organizations have only three sources of revenue. A, there are internal accruals, so what you earn from your operations, you put it back to grow the business. Secondly, one can borrow money from friends and relatives, which is a very limited source of capital. And thirdly, there are the banks, which have always been a little less than efficient when it comes to underwriting these smaller but riskier businesses. To put it differently, access to the capital markets was missing, which really deprived these SMEs of a big and stable source of revenue. In fact, this non-existent access to the stock markets also meant that external investors found it very difficult to exit a company, and the only alternatives for them as well as the promoter was to wait for a larger domestic or foreign company to acquire them. And a third problem SMEs faced was with the amount of fundraise. So typically, when a mid or large-sized company brings up an IPO, it is looking to raise at least 500 crores, which translates to a decent amount of fees for the merchant and investment bankers. However, an SME is probably looking for 20, 30, maybe 50 crores, which means the big fundraisers, at least the top 10 firms who control 90% of the IPOs, were least interested in working with them. So these were some of the capital-related problems that the SME sector faced for many decades before the Indian government started to take some active interest in it, which then led to the formation of the SME Exchange. Very simply, the SME Exchange is a dedicated stock exchange for trading in shares of small and medium-scale enterprises who would otherwise find it difficult to get listed in the main exchanges. This concept was floated by the Government of India in the year 2012, which led to the National Stock Exchange establishing a dedicated exchange called NSE Emerge, and likewise the Bombay Stock Exchange came up with BSE SME Exchange. So consequently, the NSE and BSE have two different boards now. Firstly, there is the main board, which is where we have companies like Reliance, HDFC Bank, TCS, etc. And now there is the SME board, which features the listed SME stocks. Now, like everything else, the SME platforms had to fight for their existence, quality and scale. And after some success in 2017 and 2018, it seems the SME exchange has surely found its bearings in the last 2 to 3 years, with the current year count of IPOs already crossing 100, and companies have already raised over 2,500 crores in the process. In terms of getting on the exchange, understandably, the listing criteria for SMEs is a lot less stringent, and the regulator has allowed for many relaxations in terms of the net tangible assets, the net worth, their track record of distributable profits, certification, compliance, etc. But in terms of the main features, here's what you need to know. Firstly, companies with a minimum post-issue capital of just rupees 1 crore can be listed on the SME exchange, which can go as high as 25 crores. You also don't need a lot of allottees, and a minimum of 50 with the promoter holding 20% of the equity post-issue would suffice. SMEs are exempted from the condition of having certain profit-making track record as compared to IPOs that happen on the main board. Number 4, the minimum application amount as well as the minimum trading lot shall not be less than 1 lakh rupees, which may not suit many retail investors. Then, unlike other companies, the IPO prospectus of an SME is vetted by the exchange, that is the NSE and BSE, and not by the SEBI. The financial results need to be submitted on a half-yearly basis instead of doing it quarterly, and the company can migrate to the main exchange if it is listed on an SME platform for at least 3 years. Now, some of these features, especially the point on profitability, the prospectus not being vetted by the SEBI, and the half-yearly submission of results can largely be tagged as a risk factor, and investors need to give due consideration to that. Another interesting comparison between the main board and the SME board is on the use of funds. You see, when a big corporate does an IPO, more often than not, a large chunk of that money goes into giving an exit to the existing shareholders, which includes VCs, strategic investors, some promoters, key employees, etc. However, and unless there is some fraud happening, a large chunk of this 20, 25, 40 crores that these SMEs take in actually goes in as growth capital, which is then utilized towards increasing the revenue of the company. In other words, an SME जो बेचारा capital के लिए वैसे ही तड़प रहा है, for them this IPO money can help them really scale up their revenues and profits by 50, 100, even 200%. And as an investor, I'm sure you and I would really appreciate that. Another point I want to talk about is on the lot size, and what I meant is that while one can apply for a regular main board IPO by paying 15, maybe 20,000 rupees, in case of an SME IPO, the minimum application money increases quite a bit to at least a lakh of rupees. So this is a disadvantage of sorts for the SME and also for the retail investor who now needs to buy or sell shares in an SME in lots, whereas on the main board trading can happen with even one share. As an example, let's look at BEW Engineering Limited, and the first thing one would notice are the letters SM, and all SME shares would have that label. I'll now tap on the company, click the buy button on the Fisdom app, and I'm sure you would have noticed the pre-populated value of 250 shares, which is nothing but the lot size I was just referring to. In fact, notice what happens when I tap the minus button. Yes, the quantity goes down to 0, and when I use the plus sign, then the shares get added at multiples of 250. This means for me to buy shares in BEW Engineering Limited, I'll have to spend almost 3,60,000 rupees, which might be a bit uncomfortable for the average retail investor, including myself. Nevertheless, applying towards an SME IPO or the buying and selling of shares once the company has been listed is as simple as you logging onto your trading account. Now, most brokerage platforms will also give you a list of ongoing and upcoming IPOs, so do watch out for that as well. And because we are talking about IPOs, don't forget to watch this excellent conversation between Nirav, who heads research at Fisdom, and Bharat Lahoti from Edelweiss Mutual Fund, who manages the only fund in the industry where the assets are dedicatedly invested in recently listed companies. In this Wealthcast, Mr. Lahoti details out the things we always wanted to know. So things like how to identify which IPOs to invest in, the checklist to follow, how to increase your chances of allotment, which IPOs are more likely to give you listing gains, and many more such questions, including how an investor should approach an SME IPO. This video is live on the Fisdom YouTube channel, where one can find a lot more useful stuff, so do consider subscribing, and a link to the Wealthcast is available in this video's description. Alright, one of the common concerns surrounding SME investing is liquidity, and a good way of understanding this is by looking at why and who invests in an SME. Now, because we don't have derivatives, futures and options, there are only two kinds of investors here. The first kind is the person who's running after listing day gains, and hopefully within a week of allotment, a lot of the smoke would have cleared out. Which means the investor who remains in the SME category is probably someone who wants to stay invested for a minimum period of 3 years, and in the process can reap the benefits of a probable growth in revenue, and also when the stock migrates to the main board, which is when it will attract a lot more interest from institutional investors within India and abroad. Now, this point on migration is very interesting because of the 442 companies that have listed on the BSE SME Index and 333 on NSE Emerge, well, more than one-third of them have already migrated to the main board. This is exactly what an SME investor is counting on, which can not only amount to a high return on investment, but it also offers a nice exit or liquidity to the investor. In fact, while researching for this video, I even came across articles which shows that domestic institutional investors, foreign investors, and even mutual funds have invested in SME stocks, which is a fantastic sign. And the more it happens, the greater will be the liquidity and buoyancy within the SME exchange. The next major concern amongst investors is on safety, that is the risk part of SME investing. Now, we've already touched upon some areas like the relaxation in compliances, the 6-monthly financial reporting, the high investment threshold, the liquidity concerns, etc. But most definitely, the biggest risk is around the investment itself, and there is no doubt that by nature, SMEs are very fragile. In fact, it's not uncommon to see many IPOs trading at 80, 90, 95% below their issue price because in spite of doing the fundraise, many companies fail to see any significant improvement, which is a function of their business environment, competition, government policies, growth strategies, etc. Incidentally, I was watching a video by Value Research Online where they presented some data that of the 6 SME IPOs that came out in FY 2012, none of them have made it to the main board, which is definitely something for all of us to think about. And it also means selecting the right set of companies is the key to success when it comes to SME investing. And the third and most customary of inquiries are the returns. And although I couldn't find an investment vehicle like a mutual fund or PMS, the S&P BSE SME IPO index has clocked a 3-year CAGR of 193%, a 5-year CAGR of 82%, and a 10-year annualized return of 60%. To put this in numbers, if you had invested 1 lakh rupees in this index in the year 2013, then today that corpus would have swelled to a little over 1 crore, which is 100x returns. The other indices would have come nowhere close, and in addition to high returns, the index also has the added advantage of diversification, which can potentially improve a portfolio's risk-adjusted return. Now, of course, an SME stock is a lot more volatile and riskier as compared to the main board stocks, and while there is a lot less information, here's what Kunal and I have researched on what you can do to pick the right companies. The first filter is to check whether the SME is a significant player in the industry. And since many large corporates are actually dependent on smaller companies, well, if you can find such a pivotal company, then the chances of you finding a multi-bagger definitely improves. So this is generally a monopoly type situation, and a good example of this is BEW Engineering Limited, which has a strong position in the manufacturing of process equipment for the pharmaceutical and chemical industry. In other words, any chemical plant that is coming up in India, well, there's an 80% chance that BEW Engineering would have supplied some components to them. Effectively, BEW is very significant to the chemical manufacturing process, which means this company passes our first filter. The second filter is on the addressable market, and understandably, the company you are examining should have a long growth runway in front of it. Now, it's extremely difficult to envision what the promoter or the management is gunning for or what they will do in the future, but what you want is a small fish in a large pond, and there must not be too many fishes around. The next big filter are the financials, and here we have to look at 3 major metrics, that is sales growth, which should be consistently increasing. The operational cash flow should be in line with the profits, which effectively means that the company is being paid for its efforts. And thirdly, there should be low or no use of debt, and most definitely the debt servicing ratios should be comfortable. And the final filter, and perhaps the most crucial one, relates to the person behind the wheel, that is the promoter. In fact, I was watching a video on YouTube where an SME investing expert was quite adamant that he'll give only a 20% weightage to the product, while 20 more goes to the addressable market, and the remaining 60% weightage needs to be assigned to the promoter. So while evaluating a promoter, we are looking at any past history of fraudulent or unethical practices, the project completion rate, which is in terms of quality, cost and time, his or her execution skills, and of course any documented plans for growing the business. Understandably, a lot of reading needs to be done beyond the red herring prospectus, and it won't be a bad idea to meet up with the promoter and his CFO at the company's premises. My own views on SME investing are all over the place, and honestly, I had not even thought of it before Kunal came back with this piece of research. I think it's an area I'd like to study further, and hopefully, in a follow up video, I'll be able to identify and discuss some promising SMEs and we can theorize what we can expect from them in the future. If this topic was new to you as well and you found it informative, then do tap that like button, do leave an encouraging comment, and I'll see you 3 days from now. Until then.